Let's get on with this, shall we? Today we got Bitcoin pushing even higher. This is not a bearish pattern. You are running into a very important level being monthly support. I'll go over to monthly support real quick and show you for any of you who are new and don't understand. It's just simply this lowest bearish close right there. When we got very momentous to the downside in 2022, when we pushed through that level, we never really came back and retested it. Well, we are retesting it now, and that is where you are finding your resistance on a daily closing basis. Now, obviously, this thing is extremely overbought. However, it is making higher daily closes. So it will be interesting to see if today closes higher or lower. So keep your eyes on that. For you intraday folk out there, if you want to look at this as an ascending wedge, be my guest. If it breaks down, then you can look for shorts. I am kind of taking shorts intraday, just basically scalping the ranges a little bit. I took a short right here earlier, a couple hours ago at the market close at 34,854.77. And so far that position is up around 30%. So I'm doing pretty good on that. This is the first intraday support level. So obviously I have taken profits as soon as it tagged that level. So moving on, your next intraday support would be around 34,203 if you do want to look at this area for potential short entries. If you do close an hourly candle, however, above 34,784, I would not look to short this, as there is a pretty high probability that you are going to run these two highs, which are a double top or liquidity zone or whatever. Yes, it is possible that we do get a run above that, but still, I don't know if I'd want to short that or not, as Bitcoin is extremely bullish, and we'll get into the reason of possibilities. Obviously, I know the BlackRock ETF is one of the main drivers pushing the narrative on this asset right now, as they are seeding cash to get ready for an ETF. So yeah, that's probably what really caused it. But Janet Yellen came out with an article on the 5th of this month saying some things, kind of hinting about, and we'll talk about that a little bit at the end. So make sure you stay tuned to that. All right, so that's pretty much the analysis on Bitcoin. It's bullish. It's bullish. Don't try to short it. Don't try to pick tops. All right, moving on. SPX. Going out to the daily time frame, you're going to see something, and it is called bullish divergence. Now, I only bring this up because we have had a little bit of a push down, a lower high, then a lower low, then a lower high, and then now a lower low. However, according to the momentum oscillator, there isn't that much momentum in this move lower. And this is typically when we would expect to see that momentum. So I'm not exactly looking for bullish entries right here at this point. However, if 41.36.49 holds, then I could potentially look to either sell some puts or buy some calls, looking for another move to the upside just to see, if this is going to be the low or not. Remember, I don't trade patterns or divergences or anything like that. I trade price alone. Price is king. But if ever there is a divergence showing up, I am going to tell you about it, simply because thousands and thousands of other traders will take bullish positions on the S&P 500 based on the fact that you are printing bullish divergence. Over to the Nasdaq, and we got the same thing here on the Nasdaq. Let me get rid of these two lines real quick. Yeah, you got the same thing happening on the Nasdaq. I haven't drawn up any areas of potential support yet, because I guess one could argue that this swing high would be an area of potential support. But if this bullish divergence is going to play out, you can see on the weekly you are just barely getting under that 50. So not really an area that I would be looking for shorts just yet, being that this is the weekly time frame, because you have not closed the weekly candle yet. You got one more day on this candle tomorrow before you close, and this thing could go whoop right up out of that area, just like it did there. All right, so we shall be keeping our eyes on it. But is this the time to look for fresh shorts on the SP 500 and the Nasdaq? For that, my answer would be a no. All right, now we do have a couple daily supports in here, and I would probably say if you get down there to that 13,565 area, that any upside bullish continuation would probably be negated at that point. So moving forward, just a quick thought, this thing could be flagging out as an ultimate bull flag. All right, and now for the grand crescendo. This is an article that was put out on October the 5th, which was a long time ago. However, it was just recently brought to my attention. But anyways, I'm not going to get into this, but this is Yellen's prediction right here. She says that debt service costs will be 1% of GDP for the next decade, according to Reuters. That's what she told Reuters. What we're going to do is I'm going to link this in the description. If you want to go check out the whole article for yourself, you can. The link will be in the description. I am going to come down here and spoil the plot. In the 5 years leading up to the pandemic, nominal GDP grew at 5.03% annually. Let's optimistically assume growth continues at 5% consistently for the next 10 years. Now let's tack on an even bolder presumption. The government balances its budget every year for the next 10 years. Thus, the amount of outstanding debt will remain constant. For context, in the last 57 years, there has only been 1 year in which the amount of debt has not increased. In such a far-fetched scenario, the debt to GDP ratio would drop considerably to 70%. However, interest costs would equal 2% of GDP. Such is much better than the current 3.36%. But double Janet Yellen's 1% objective. Budget surpluses for the next 10 years would lower interest expense even more and possibly get the interest expense to GDP ratio to 1%. However, the odds of a unicorn spraying rainbows across the sky out of its butt, the government running a surplus, are the same, 0%. Consequently, we exclude surpluses as a viable way to reduce the interest expense to a more manageable level. Balanced budgets or surpluses are unrealistic given the political and fiscal trends. Further, the economy relies heavily on government spending. While fiscal prudence would be a good in the long run, obviously, the short run effect would be a recession. Instead of using pipe dreams as scenarios, let's get realistic. The more likely, albeit still optimistic scenario, keep that in mind, it's still just an optimistic scenario, involves the debt and GDP growing at the same rate. Let's also assume interest rates remain at current levels. In this exercise, we assume an average borrowing cost of 4.75%, which is a little below the current weighted average funding cost for the government. Under this realistic picture, interest expense would climb to 5.6% of GDP. The only logical variable in the equation that can make Janet Yellen correct is the future interest rate. To arrive at Yellen's 1% figure, assuming debt grows at the rate of GDP, interest rates must be much, much lower. In time, a weighted interest rate of 0.85% would put the nation's interest expense at 1% of GDP. We are sitting between 5.25 and 5.5% interest rate right now. That literally means that the Fed would have to start cutting interest rates to realize that goal. So the market may be sniffing this out. Like I said, Janet Yellen did not come right out and say that they are going to be cutting interest rates, but we also know that the fiscal spending of the government is unrealistic, right? They are not going to stop that. So with that being said, I hope you guys enjoyed the video. If you did, make sure you smash the like button. You can come check out this article. Like I said, it's got a bunch of little charts and stuff on it and a lot more to read. But with that being said, make sure you guys trade safe. Make sure you trade smart. And as always, happy trading, everybody.